So this is the second video on the basics of money market funds, and the second video in our series. The first video we covered what are money market funds, the regulations around money market funds, and what would happen if the company you have invested in went out of business. So if you have not watched that video, make sure that you click here to watch that video. So in this video, we are going to cover how the money market funds work. So let's get into it. So 4 things. When you invest in a money market fund, number one, you buy units or shares of the fund, which I'll explain in a bit. And number two, the fund manager takes all the money from investors like you and me, and they spread it across different safe short-term investments. And as these investments earn interest, you earn money too, okay? Let me break down how investing in a money market fund actually works using some real numbers. So think of money market funds like a very big pool of money. Let's say we are just taking an example. Let's say 5 billion Kenya shillings. Then when you invest in the fund, you're buying units, which are basically your shares of that big pool. So if you only invest like 50,000 Kenya shillings, you get to benefit from the returns of the entire 5 billion Kenya shillings being invested in good deals that you couldn't access on your own or with the cash that you have at hand. Let me give you a practical example. So let's say you invest 50,000 in a money market fund. Each unit costs 1 Kenya shilling, so you get 50,000 units. The fund manager invests the total pool of 5 billion Kenya shillings in various opportunities. When the investments earn returns, you get your share based on how many units you own. Let's now look at how your 50,000 investment would look like in 1 year. So you invest 50,000 in a money market fund, each unit costing 1 Kenya shilling, so you get 50,000 units. Let's say the fund earns 15% per year through, though this can vary. After a year, your 50,000 would grow to about 57,500. That is after a year with an interest rate of 15% per year. Here is something very important I want to emphasize. When investing in a money market fund, you need to keep adding to your investments over time. And this is the best strategy that is going to work very well for you. Let's say every month you are able to add even just maybe 5,000 Kenya shillings to your investments. Here is what would happen to your account. So you start with 50,000 Kenya shillings, and then you add 5,000 each month. That will give you 60,000 more over a year. Okay. With the same 15% returns, after a year, you could have around 120,000 Kenya shillings. The beauty of money market funds is that they make it easy to keep investing. Maybe this month you can only afford maybe 2,000 Kenya shillings. Next month, maybe 7,000 Kenya shillings. Whatever works for you. Every little bit helps, and over time, these small additions really add up. So how do the returns work? So unlike the stock market where share prices go up and down dramatically, money market funds keep their unit price stable at 1 Kenya shillings. Your earning comes from the interest the fund generates. So in our example area, rather than the unit price going up, you would simply earn more units. After a year, instead of maybe 50,000 units, you would have about 57,500 units. Now this is into addition to your interest that you have earned over that 1 year. And then from there, the interest that you earn will be from those 57,500 units. And this is now what we call compounding. Okay. So, and if you have been adding money throughout the year, you'd even have more than the 57,500 units. You'd have more. So let's look at the benefits for investing in money market funds as an investor. Let me tell you why MMFs are particularly interesting for us. They offer high returns. Usually money market funds offer much better interest rate than savings account. Think about it. Many savings accounts offer 2 to 3% per year, while money market funds can offer up to 15% per year, depending on the account that you have opened. That's a very big difference. For example, now on our 50,000 Kenya shillings, that's the difference between earning 1,500 in a savings account versus 7,500 in a money market fund account. So you need to consider moving your money from a savings account to a money market fund account. Number two, they offer flexibility. You can start with what you have and keep adding as you go. Even if you can only add 1,000 Kenya shillings or even 2,000 Kenya shillings a month, or even 100 per day, it will all add up over time. Number three, you're fighting inflation. This is very huge. Over time, inflation eats away at the value of your money. If you're putting it in an account that have low interest rate and compared to the inflation rate, you're losing a lot of money. By earning higher returns in an MMF, you are better protected. You have better protected your money against inflation. Number four, we have accessibility. Most fund managers in Kenya have made it really easy to invest. You can often start with as little as 5,000 Kenya shillings, or even 1,000, or even 100. And they even manage your investment through, you can manage your investment through an app. So it is that accessible. Number five, you have professional management. You don't need to know the ins and outs of the investment. The licensed fund managers handle that for you. You only wait for the payday. This is what they call money working for you, and you should get into this train as soon as now. So I want to be clear about something. While money market funds are great, they shouldn't be your only investment strategy. They are one piece of the puzzle. In the future videos, I'll be talking about other investment opportunities like equity funds, bond funds, and even real estate investment trusts, each of which plays a different role in building your wealth. Now, here's my personal take. You know what I love about money market funds for us? They are perfect for that money you might need soon, but want to earn something on that money in the meantime. Maybe you are saving for a wedding, a car, or just keeping some emergency funds somewhere they can grow a bit. You might also be saving for your kids' education. This is somewhere you can put that money, and it will keep earning some interest as you wait for your kids to get to that level where you're paying their fees. So that marks the end of the basics of money market funds. And don't forget to watch the first part of this video so that you can connect with what we have talked about in this video. And in the next video, I'll dive deeper into how to choose a good money market fund in Kenya. And if you found this video helpful, don't forget to like and subscribe, and also share with your friends. It really helps the channel grow. And let me know in the comment section if you have any question about money market funds. I love hearing from you guys. Thank you for watching, and I'll see you in the next video. Bye.